Hello and welcome everyone. Thank you so much for your time. Today we will be looking at my analysis on Starbucks with the intention of making a worthwhile investment for our company. Let's first start with a little bit of background. So Starbucks opened its first store in 1971. The company was started in the historic Seattle Pike Place Market. And in 1981, Howard Schultz started selling his coffees, and the brand grew from there. Now they sell freshly made coffee as well as specialty brewing machines and memorabilia for true coffee aficionados. But let's look at the company today. Starbucks has grown all over the globe. They currently have 27,000 stores as of 2017 and are in 62 different countries. All of that is good and well, but let's look at the real reason for this presentation. Should we be investing in Starbucks? And when I say investing, I'm asking, should we be making a direct equity investment, not looking at investing by purchasing stock, but instead whether the company will be worth investing in. To do this, let's take a quick look over their financials. So I've put together a few Excel spreadsheets for some of the important data to look at the profitability and success of Starbucks over the past few years. For right now, let's just look at the past year. Last year, Starbucks did $22 billion in revenue, $13 billion in gross profit, $2 billion, almost $3 billion in net profit, and maintained a 60% gross margin. Now let's look at some efficiency ratios. The revenue has stayed the same from the past slide, the $22 billion, but now we've included the cost of goods, inventory, accounts receivable, and account payable. All of this was used to generate the revenue per day and the cost of goods sold per day. In this calculation, I assumed that Starbucks would be operating 360 days a year because that seems about on point for most American companies. And in doing this calculation, I saw that the revenue per day is about $62 million, while the cost of goods sold per day is $25 million. The days in inventory is around 54. Collection period 14, payment period 117, and altogether the cash collection cycle is at a negative. So moving on to the liquidity ratios. Let's dive a little bit deeper into the real deep financials of Starbucks. So Starbucks debt to equity ratio has deteriorated from 2015 to 2016, and then again from 2016 to 2017. They are fairly low, but they have been increasing over the past 3 years. Starbucks interest coverage ratio has also been deteriorating over the past 3 years, but it seems like they are still paying back their interest effectively, which I think is the more important point. Moving on to some leverage ratios. Starbucks Corporation's current ratio deteriorated from 2015 to 2016, but then improved from 2016 to 2017, even exceeding the 2015 year, which is pretty impressive. Starbucks Corporation's quick ratio improved from 2015 to 2017. Starbucks seems to have a healthy ratio for making short-term goals. They've been keeping their current ratio above 1 over the past 3 years, though their quick ratio has been around 0.6. They did raise it to 0.84 last year, but this does make me a bit weary, but it seems like their ratio is at least moving in the right direction, which is an important thing to note. So now let's take a broader look at their trends. Over the past 3 years, the revenue has increased on a fairly linear scale, and they have increased across the board, even from revenue to gross profit, operating profit, net profit, Total assets, total equity, everything has been on the rise. I meant return on equity has been on the rise. Total equity has gone down, but they have it compensated with the rest of their numbers. So then looking at the cost of goods, inventory, accounts receivable, accounts payable again, all of these numbers have been on the rise, and they have been making more revenue per day, cutting down the days in inventory, maintaining a collection period and a payment period, and their cash cycle has stayed negative. So now let's look at some of their competitors. I chose McDonald's and Dunkin' Donuts as their main competitors because I see Starbucks as a breakfast place as opposed to an eatery. And I would say that the biggest competitors that Starbucks would have for a morning coffee rush would be McDonald's or Dunkin' Donuts. So here is a comparison of the percentage change of their stock over the past 5 years. Starbucks is dictated in green, Dunkin' Donuts is dictated in pink, and McDonald's is dictated in red. As a reference, Starbucks did $13 billion in gross profit last year. McDonald's did $10 billion in profits, and Dunkin' Donuts did $700 million in profit. McDonald's released last year that it makes $30 million in coffee sales per year, while Starbucks is doing, my guesstimation, the majority of their sales by coffee. But this does also include their other sales for their memorabilia and sandwiches and so on. So let's compare the finances of these three companies. You can see that Starbucks and McDonald's make about the same in revenue, the $22 billion, but Starbucks makes about $3 billion more in gross profit, resulting in the $13 billion that they made in comparison to the $10 billion that McDonald's made from last year. While Dunkin' Donuts is kind of the underdog in this story, they did not even break $1 billion, but they do show from gross margin and operating margin that they are creating a higher margin than their two large competitors. And I also really enjoyed this slide because you can see how varied these three companies are, especially looking at the percentages that are resulting from their revenues over the year. I think the most notable differences are in gross margin and the return on equity. Gross margin, Starbucks is at 60%, Dunkin' is at 84%, and McDonald's is at 47%. And the return on equity is clearly very different. Dunkin' Donuts has been on the rise, and clearly their return is showing that. Whereas McDonald's has been kind of in a lull because they haven't really been maintaining their newer audiences and are still trying to appeal to the older audience that gave them their success for so many years. I think one of the things that is really standing out is that Starbucks and Dunkin' Donuts are maintaining relatability with their audiences, whereas McDonald's is trying to relate to new audiences, but it's hard for them to break out of the customs that they have set for themselves. So now let's go into the summary of everything that we have discussed thus far. So some of the important things to remember is that Starbucks did do $22 billion in revenue last year, and then maintained a gross profit of $13 billion. And they have maintained a healthy balance over the past few years and have not really strayed from their path and have been able to stay profitable and even increase revenue, which is something that is notable and impressive. And then a little bit about the comparison. Starbucks has stayed up with their audience and has been able to increase sales even while the economy seems to be in a little bit of a decline. And fast food chains are really taking a hit, but Starbucks has been able to stay above the competition and maintain that strength, which I think is really something notable and impressive. So, on to the most important part, the final recommendation. And of course, I say yes. I think that Starbucks is a worthwhile investment, and they have proved that they are able to maintain profits, and if not maintain, exceed those profits. And I wanted to end my presentation on something I saw a long time ago that kind of stuck with me, and it's a quote from Benjamin Franklin. An investment in knowledge pays the best interest. And I really think that I have presented quite a bit of knowledge in this presentation, and I really hope that you take out as much as I put in. So thank you guys so much for listening. If you have any questions, of course, reach out, comment below, and yeah, thank you guys so much for your time.